Good morning, everybody. Welcome to this week's long form episode here on Mining Stock Daily as we get you through the last week of March 2025 and into Q2. We got a special interview here with our good friend Jordan Roy-Byrne of the Daily Gold. It's been a little bit since Jordan's been on the podcast, and for good reason. He's got a new book out. So we're going to talk about this book, where you can find it, but also some of the implications of what's happened since he's published this book and the gold price. It's really important. We cover a lot of tremendous insights of why gold has been running the way it has been above this $3,000 mark, and where does it go from here. So a lot of insight here from our good friend, the technician, Jordan Roy-Byrne. Special thank you to Caliber Mining, Integra Resources, and Vizsla Silver for their continued support of Mining Stock Daily. And as always, if you wouldn't mind, hit that like, subscribe, and share button, whether it be on the YouTube channel or also on the podcast network. You do receive MST. All right, everybody, enjoy this conversation, timely conversation with Jordan Roy-Byrne. All right, welcome into this week's long form episode here on Mining Stock Daily, and it's going to be an important one, a big one, because that's the first time we've had Jordan Roy-Byrne on for the long form. Obviously, he's been a frequent guest here on Mining Stock Daily for the last few years. Provides great commentary and technical analysis within the precious metals market. But it's been a little quiet from Jordan here in the last couple months, but there's good reason. He's just got a book published, which you can find for free on his website, The Daily Gold. The title of the book is called Gold and Silver: The Greatest Bull Market Has Begun, a once-in-a-lifetime investment opportunity. I know a lot of sweat, tears, and late nights went into this, Jordan. So first off, my friend, congratulations on getting this published. Hell of an achievement. Good job.
Well, brother, thank you so much for having me on the show. And what a nice compliment. I don't think anybody said congratulations to me yet. So thank you so much for saying that. And I'm just really excited to get it out. You know, all my work, all my thoughts, and boy, the timing is really perfect. I know we're going to get into it, but I can't say that enough. Just the developments that we've had in the last 2 or 3 weeks here in precious metals, boy, it's a big part of the book, what's happened. And I can't say it again. The timing is really perfect.
Yeah, you've been obviously providing, you're a contributor with the Clear Commodity Network. And so we've been sharing a lot of the content you've been publishing on your YouTube page or YouTube channel for the number of weeks now. It's just been very, very frequent. So thanks for, providing that commentary into the network as well. But the synopsis of this book, it's a comprehensive document that argues gold and silver that's entering a new secular bull market driven by factors: end of a bond bull market, rising inflation, government debt problems, perhaps yield curve control on the horizon, and these de-dollarization trends, which maybe is a topic you and I can get into a little bit more, because I tend to disagree with some of the aspects of the de-dollarization crowd on a few different levels. But maybe before we kind of get into this, Jordan, listen, we've all known you as, the TA guy for precious metals. I don't know if we've ever gotten the background of why this is the path you've gone down in your career. What started getting you not only in precious metals, but really into technical analysis? What kind of spurred that inspiration at first?
Well, what spurred that was the genesis was I started investing in the late 90s, had no idea what I was doing, was following tech stocks because they were going up. I mean, I was a complete neophyte. Yeah, I'll buy this one. This is going up. I think this is going up. This is a good company. I'll buy that. Now, I got in early enough where I actually made money, and I kept a chunk of the money that I made. But of course, I lost money on the way down. And a big problem was I was still buying things on the way down thinking, oh, we have this huge decline. Like, what a great buying opportunity. And so, that was 2001. And, after a year or so, it was clear, that didn't work. And so 2002-ish, 2003, I thought, there has to be something that really explains why markets are moving the way that they do beyond just fundamentals. And so I got into technical analysis, started studying it 2002, 2003, started doing the exams for the CMT. And so that was really the genesis. And I did have some smart people in my life who they even mentioned, I think in the year 2000, oh, you should look at gold. Tech stocks are in this huge bubble. You should look at gold. Like this could be the next huge thing. And I don't remember exactly when, but I kind of had an epiphany, I think 2003-ish. And I thought, okay, this makes a lot of sense. I think commodities are going to have this huge run. Like this makes sense to me. And so at first I got into energy stocks because I thought, well, they're making money. This is easier to track. They're making money. I mean, gold and silver, I think I want to, I am bullish on those. They sound right to me, but I don't quite understand the companies, and it's a little more difficult because they don't make money or cash flow as much as the energy companies. So first I went into oil and natural gas, and then in gold and silver, I got really lucky because looking at gold before 2005, I thought I was looking at the technicals. I was thinking, okay, if this can break, I believe it was about 450, if it could break 500 in there, like this has a chance where it could run to 700. So I got really lucky where that '05 to '07 move timed it perfectly. And so that was kind of my how I got into technical analysis. But beyond that, after we had, what at the time nobody knew, but it was the end of a secular bull market in 2011. So after that, 2012, 2013, I decided to write the first copy of this book, but it wasn't that significant because I was thinking, okay, there has to be something that really understands, like why is gold crashing? Like what's the reality? What are the real fundamentals? Like how does gold really move? And so I wrote the first iteration of the book in 2015, which was really the big point behind that was precious metals are completely bombed out. Like this has to be a major bottom. Like valuations are the lowest we've ever seen. Now, I was right about that, but my larger macro was not correct because I thought we're going to have this move that was like 1976 to 1980 move in gold. And the stock market is still in this big secular bear. But that was off. I mean, I was right that precious metals were making this really significant bottom in terms of price, but my larger macro view was incorrect. Now, I think the second edition of this book, which I think came out 2019, 2020-ish, at that point, I did realize, okay, the stock market is in a secular bull, gold and precious metals. We're still in a secular bear, but we've put in a bottom. And the 1960s, like everything that's happening, the 1960s really explains what's going on. And in the before the third edition, which is the current edition and really the most complete and by far the best one, in the last few years, we did get the bond secular bull market ending, as I show you with my charts in the book. And so that secular uptrend has ended. And similarly, the secular uptrend in bonds ended in about 1965. I'm looking at I think it's the 80-month moving average of the total return. And you can look at these charts. When that loses the 80-month moving average, it's clear that the secular bull in bonds is over. So it lost that in 1965, lost that, I think, in late 2020 or maybe 2021, 2022. So it lost it just how it lost it in the mid-1960s. So all these factors are really coming together that have led me to this overarching view that, like, wow, there's a lot of similarities with the 1960s. I mean, as far as technical analysis, in I think in 2016 I did do an international program where you can get what's called a master's in financial technical analysis. And to get that, you have to write a thesis. So I was writing a thesis paper on moving averages, and essentially why, for me, the 400-day moving average is more significant as far as being a sell signal than the 200-day. So I wrote that paper, looked at a number of different markets, and they passed me. So it was really nice to receive that. And like any other pursuit in life, being able to look at technicals and charts and understand that for now, I've been doing that for over 20 years. But like anything, you get better as you age, as you pick up more skills. So I feel much better about my technical analysis now than compared to 5 years ago, 10 years ago, 15 years ago.
Yeah, I think the technical analysis, obviously, that's been playing a large part in this recent thesis, and has definitely been a driving force within the book, because we've chatted about it for the last couple of years as really this breakout of the cup and handle pattern on the gold chart. And I've leaned towards you and me as not a technician of charts by any means. I can draw lines and make a thesis from that, but obviously I don't have a master's or have written a dissertation on technical analysis like you have. So I lean on you for a lot of that information, Jordan. But this cup and handle has obviously been a huge driving point. And maybe talk about this breakout of this 13-year cup and handle pattern and how it's also kind of leading, another, ingredient to this secular bull market.
Well, cup and handle patterns, I think they were developed by Bill O'Neill, Can Slim, I think Investors Business Daily, and I think he developed this in the late 80s, although it may be incorrect about that. But it's really a momentum-based pattern where a market basically makes this giant U shape where it has this big sell-off, but then slowly over time, like a U, it kind of recovers and it comes back to the high. Then it has a smaller correction or consolidation before breaking out of the overall pattern. And with respect to gold's pattern, I mean, this is a pattern that will be in technical analysis textbooks of the future, because doing a lot of research on this, I could not find like cup and handle patterns, historic ones, that were as perfect as this one in gold. I mean, I saw ones that were slightly similar, but just they didn't fit the pattern as perfectly as this gold pattern did. And so you take the pattern, you take the top of the cup down to the bottom, and then you add that, from the top forward, and that's how you get a measured upside target, and that is actually $3,000. So we've hit that target in the past few weeks. But another thing you can do is if you just take the percentage of that move. So if you're taking 2,000 and 1,000, the measured upside would be 3,000 because you're just using addition. But if you take the percentage, so 1,000, 2,000, that's a 100%. That would give you a log target of 4,000. And depending on how you look at it, it might be 4,100, it might be 3,900. But so I'm calling the log target 4,000. But here's the thing. I looked at historic cup and handle patterns that were most similar to the one that we have in gold. And those patterns all went from the measured upside target to the log target in 6 to 12 months. So based on that, that would tell us there's a chance that gold could hit now 4,000 in 6 to 12 months. Now, the larger significance is that in major markets, these types of breakouts, these multi-decade breakouts, are really rare, and they set the stage for really, really significant moves, not just for the next few years, but I mean, in most markets, they can set the stage for moves beyond a decade. I mean, more than that. Now, with respect to gold, gold's a little different. It's more emotional. The market can go parabolic, but still, breaking out of a 13-year cup and handle pattern, that's going to lead to some spectacular moves over, not just the next year or two, which we've already seen in the next year, but really the next 5, 6, 7, 8, and ultimately 9 or 10 years.
Yeah, and I was actually, there's a follow-up question I had for you, Jordan, just kind of based on similar, excuse me, similar trends, these cup and handle patterns that you've seen. What were some, other, I guess, what I'm trying to say, similarities where, like, this has been a 13-year pattern formation, right, that just recently broke out. What are some analogies or other patterns that had a basement of that long, and what did they end up doing? I mean, and I guess the question is, how does the length of that pattern shaping out play into the outcomes of what happened, say, in the next 13 years?
The longer the pattern, then the bigger the breakout that you're going to have, and the longer that breakout move and the ensuing rise or bull market will last. Now, there's no, I would say, really perfect examples, but probably the best comparison is the stock market from 1937 to 1950. Now, it did not originate from an all-time high, but it was pretty close. But so you look at the S&P or the Dow from 37 to 50, that was 13 years. So these patterns broke out in 1950. The absolute strongest period for the stock market in its history, in my opinion, was 1949 to 1957, where I think you only had one 20% correction during an 8-year period. So just a super strong 8 years, really only one minor correction along the way. I mean, that's unheard of in capital markets history. So that cup and handle in the stock market gave way to a spectacular move for the next 8 years. And that gave way to a move eventually much longer than 8 years. I mean, talking about other significant breakouts, we know the Dow had a consolidation from 66 to 82. That was a 16-year breakout. The S&P from 2000 to 2013, that was a 13-year breakout. So those were not cup and handles, but they were breakouts to a new all-time high from a 13-year base, and then again 66 to 82, a 16-year base. So you've seen those breakouts in stock markets. I mean, there are some other examples in the book, but I don't think they come out to be 13 years. I mean, I will mention, moving a little away from the cup and handle pattern, copper's breakout in 2004, 2005-ish. I think that was from a 32-year base. So copper had a really explosive move after that breakout. Same thing happened with oil. Oil, 2004, 2005, had a breakout from a 23-year base. So when you have a breakout from that long of a base, you're going to see a really spectacular move. Now, things can differ a little bit. I mean, is it a commodity that's breaking out? Is it a stock market that's breaking out, or a particular stock? But people need to understand, when you're breaking out from that kind of a long base, it's just really, really significant for that market.
Obviously, there's a lot of TA in this. Watching the historical patterns of these charts, specifically the gold chart. But behind the moves on the chart are fundamental reasons for the moves. And, what have you taken away as far as connecting the patterns on the chart with significant, maybe economic cycles that's been really being the fundamental driver behind the moves?
Yeah, very good question. And so looking at technicals in these charts, I like doing what I call macro technical analysis, where you're evaluating how the various markets and asset classes are moving, in nominal terms, but also in relation to each other. And so you can look at how they're acting and kind of guess, or at least sense, okay, what's the larger macro picture here? And I'll just go back to the last question for a second, because I mentioned the 1960s before. And so in the mid-1960s, like, what's interesting, what happened in the mid-1960s, and by the way, there's only been one from 1920 to 2020. The only secular bear in bonds was about 1965 to 1982. So until the last few years, there was only one period where you lost money in bonds over the past 100 years. Mm-hmm. So we don't, people today, we don't really have that great of an understanding of the significance of a real bear market in bonds. And so going back to the 1960s, because you couldn't buy gold, I liken gold today, and you can just say GLD, that was gold stocks in the 1960s. Because how did people get exposure to gold? They didn't. They couldn't. So they got exposure to gold by buying gold stocks. And so in the 1960s, in the late 1964, the gold stocks broke out of I believe it was a 28-year base. So we're talking about base breakouts. I forgot that. That's one of the biggest breakouts of all time, by the way. So the gold stocks in 64, 65, and they had an incredible run from 64 until 1980 when they peaked. Now, I think in there they did have two periods where they lost 65%. So it was an incredible run, but there were some big downturns. But the point I'm getting at is that occurred around the same time when the secular bull in bonds ended in 1965. And so first the secular bull in bonds ended, and then the secular bull in stocks, in U.S. stocks, ended at the end of 1968. And then eventually after that, of course, we had this huge commodity move. But there was overlap because based on the price of silver was going up in the 60s. I just mentioned gold stocks. You can actually go back a little bit further. Gold stocks really had a great move from 1960 to 1980. So there was some overlap, between gold stocks and the stock market. But if you're thinking about that, you see what happened in the bond market in the mid 1960s as inflation started to pick up, interest rates are moving higher, and so eventually, what happens is that bond bear market leads to a stock bear market. And by the way, based on what I've analyzed and researched and talked about in the book, the secular uptrend in the dollar, I know it hasn't hit a peak for a few years, but the dollar has been moving up alongside the stock market since 2011. So those things are connected. So ultimately, what we're going to see is we've already seen the end of the secular bull in bonds, in the past few years. I don't have the chart exactly in front of me, but so that has ended. So the larger trend of that is down. And so that money has been going into the stock market, tips to a lesser degree, gold to a lesser degree, maybe to a medium degree gold. So that money is selling bonds, moving into other places, but it hasn't completely abandoned the stock market yet. But ultimately, based on the lesson in the mid to late 1960s, that secular bear in bonds, the new secular bear, that eventually is going to hit the stock market and the economy, where that will end the secular bull in the stock market. And at the same time, that's going to end the secular bull in the dollar. So, I don't know if I answered the question directly, but very, very big picture, what we're seeing in the asset classes is the new secular bear in bonds. That has already led to a new secular bull in gold and hard assets, commodities as well. But the next domino to come, and I don't know if it's going to be in a year, 2 years, or 2 or 3 months, will be when the secular bull in the stock market ends. And so after, when that cracks, you're going to see, a major next leg higher in gold and hard assets. And I know we can get into it, but we can talk about gold against the stock market and gold against the 60-40 portfolio, because that's also plays a big role in this.
Yeah, I do want, those are topics I do want to cover, and I think one of the things that you maybe didn't mention there within that time frame between the 1960s and 1970s, as you could see things kind of crumble, that was a very heightened inflationary trend as well for, I think it was like 12 years. Don't quote me. I might be off, but obviously we saw 3 phases of inflation move higher before Volcker came in and absolutely crushed it with very high interest rates. But that comes back, so you can see some rhymes here of what happened in that time frame, 1960s, 1970s, to what is potentially happening now. And obviously history doesn't always repeat, but it certainly does rhyme. So we have seen the bull market in bonds come to an end, as you have expressed, but really due to a lot of the economic maneuvers coming out of COVID, all the money printing, increasing inflation to almost double digits. I think the real inflation numbers were double digits, but not the government numbers, obviously. The need to raise interest rates quickly and really crush, 2022 was a crushing moment for the stock market, but it did rebound. We will see where we're at now. But so kind of given the lay of the land here with what's kind of falling in place now and how it stands up to the 1960s, 1970s, I guess you've emphasized real interest rates as a primary driver for gold. You've highlighted the current secular bear market in bonds. But how do you anticipate the interplay between inflation, the Federal Reserve policy, and real yields kind of moving forward? Do you expect that inflation is going to play an important part in this potential hitting that log of $4,000 target for gold?
Yeah, it's a really good question, because we have not seen, gold has had this huge move in the last 12 or 13 months, but we have not seen a real pickup in inflation. And by the way, copper, as we're speaking, we're in the next couple, maybe when you publish this and release this over the weekend, I'm assuming there's one more trading day in the quarter of the month, and it looks like copper is going to break out of this 13-year, or even you could measure it even longer. Copper, by the way, is breaking out of this big base at the same time. So, sorry, not to go back to the last question, but looking at, you look at, okay, gold's had this big breakout. Now we see copper, eventually silver is going to, so you're looking at all these metals and commodities. They're breaking out of long bases to new all-time highs. That based on, okay, we have the secular bear in bonds. So that's setting the stage where the market from a 50,000 foot view is telling you, okay, inflation is coming. Inflation is the big trend over the next decade or two. Now, as you mentioned, there are waves of that. We're in a down wave right now. And to get to your question, if we remember during COVID, precious metals did really, really well at the beginning of that, but they peaked before the inflation really took hold. So, I'm not an economist, but even an economist can't predict perfectly when the next wave of inflation is coming. But with respect to gold, you might step back and think, okay, well, we're not seeing inflation. Real interest rates haven't really collapsed that much in favor of gold. So, gold is not doing exactly what it should be doing here. I'm getting into the reasoning of why gold should rise. But we are in a period where it's a little different, where the real interest rates, they can really fluctuate along with the gold price when you're in an inflationary period and you do have a secular bear in bonds. And this is something, I touched on it a little bit in the first chapter in the book, but it's good that I waited, because if I published this book a year or 2 years ago, like I was planning, there was nothing in there about the secular bear in bonds. So this is a really big deal, because the secular bear in bonds is why gold has done so well without, the help of a weak stock market or a weak dollar or real interest rates really collapsing. But the point about real interest rates is the correlation is really, really strong. Not quite as strong when you're in an inflationary period in a secular bear in bonds, but they don't align perfectly. Like what you find is that gold leads the move in real interest rates. So the big move that we've seen in gold is anticipating some decrease in real interest rates. So who knows if maybe we have a recession coming, or just an economy that really slows in the coming months and coming quarters, and they have to cut rates significantly, then you're going to see real interest rates move higher. So my larger point there is that gold typically leads real interest rates at major turning points. Now, how does gold get to 4,000? It could be what I just said, where the economy gets a lot weaker. It looks like it's going to a recession. Maybe inflation expectations come off a little bit, and that's enough for the Fed to finally say, oh, okay, we're going to cut. And then so they cut by a point or a point and a half, and real interest rates, of course, in that scenario would come down significantly. And so that could be, the catalyst to move gold to 4,000. But two things. Number one, gold would anticipate that move before it happens or as it's happening. You see gold trending higher even before the Fed shifts policy. The other reason could be maybe we don't have a recession, but inflation expectations really, the economy stabilizes, but inflation expectations are just a bitch, and they really start to rise. And so then there's real worries about stagflation, where, the economy's not going into recession, but it's just limping along. It's weak, and prices are starting to creep higher again. So it could be, one of those two scenarios, I think, could be the reason why gold moves to 4,000. So I know that was a really long answer, but I hope I covered it.
No, but it makes me wonder, if you look back at the last 4 months, what's been the driving force behind the gold price there? Because it seems very much the expectations that Donald Trump was going to win the election. We knew a little bit about what his economic policies were, what his geopolitical policies were. And so it seemed like gold was somewhat starting to front run those ideas. And then he comes into office, and we all know he wants a weaker dollar. He wants, lower interest rates to help his economic agenda. And so it does seem like gold was kind of front running that. But on the back of it, you also have this, physical movement of gold from east to west. and central banks buying all around the globe. So there's a lot happening. Like this, it's been a very, very active gold market, both in the physical trade, but also in kind of the, this, I don't want to say speculative, but at least the investment mentality of a new place to be held, gold having a new place to be held in your portfolio. So, how have you been watching the last, if I dare say, 4 months since the election? Like, what's been the driving force behind that?
Well, first, and again, not to go back to the last point, but you brought up central banks, which is huge. By the way, I would throw that in with why was gold so stable in recent years? Why was it able to break out? Of course, I mentioned the secular bear in bonds. The other reason was central bank demand, which really helped it along in I believe 2022 when we had that sharp correction. It helped give it a footing. But with respect to the last several months, I have been watching, gold against the stock market, gold against my 60-40 portfolio indicator, because that's been the big thing with respect to the last, 5, 6, 7, 3 years, 8 years in gold. Yeah, we've trended higher. We kind of have this uptrend in the stocks, but it doesn't really feel like a bull market. Juniors aren't doing that well. The sector hasn't been able to get a lot of momentum. Most of the valuations are not doing anything. And, my answer for all that is the stock market was outperforming gold. And so too much money was going into stocks and not enough into gold. Yes, central bank money was buying gold. Yes, some money was coming out of bonds and buying gold, but a lot of that money coming out of bonds also went into stocks. So, and so back to my ratios, I constructed a 60-40 portfolio, based on historical data, total return for stocks and bonds going back 100 years. And so I looked at, okay, gold divided by this total return of this portfolio, what can this indicator tell us? And it gives us a good sense of when is money starting to move out of gold and, move out of stocks and stocks and bonds, conventional assets, and when is that moving in favor of gold? And so in the last couple weeks, what we saw is that gold against the 60-40 portfolio, that ratio broke out of a 10-year base. Now, this was increasing since the end of 2021. It was climbing a little bit in favor of gold, but we didn't have a big breakout until the past few weeks. So that broke out of a 10-year base, which is really exciting because people can recall just moments ago talking about the significance of breaking out of long bases and long ranges. So this ratio, gold against the conventional investment portfolio, broke out of a 10-year base in favor of gold. And the reason why that ratio did not break out sooner was because the stock market was too strong. Gold was outperforming the 40% of that really strongly, which was bonds. Gold has been crushing bonds. But recently, gold hadn't been crushing the stock market, which is 60% of that indicator. But as I said, in the past few weeks, gold against the S&P 500 broke out of a 4-year base. And it's a clear breakout. And by the way, I'm looking at major long-term moving averages like the 20-month, the 40-month, the 80-month. I'm looking at the last 100 years. These are clear breakouts in favor of gold. So this is a massive turning point for precious metals because not only does this confirm a new real bull market in gold, but this is going to set off another maybe nearly a decade of strength and an uptrend and much higher prices in precious metals. And so, by the way, the last time we had significant breakouts in favor of gold against the 60-40, you got to go back to 1930 was one. The next one, I believe, was the end of 1971 and then the end of 2001. So those are the last times we got those signals. And just to add on top of that, when I use gold against, when I do gold stocks against the 60-40, because remember, gold stocks in the 1960s were gold. That broke out in favor of gold stocks in 1965. So that to me, I know I'm probably getting away from the question, but that to me, what has happened in the last, really this month and in the last 3 weeks, extremely significant because it's a big part of the book. I'm talking about, why aren't juniors doing better? Why aren't the minors going up more? Blah, blah, blah. The answer, and this is and this is where, to me, this is where technical analysis is really valuable. It's when you're looking at all these markets, comparing them against each other. This is called intermarket analysis, by the way, which was a field created in technical analysis, created and developed in the early 2000s. So this was not around prior to 2000. But this is where technical analysis is really valuable. It's not valuable when you're looking at, oh, well, silver's going to go to 37. It might go down to 32. Then it's going to go to 38 and 48. And I think, my cycle says it's going to break out, August 17th. It's going to happen. That is not valuable for anyone. But when you take a 50,000-foot view and you're looking at intermarket analysis, you're looking at markets against each other, the way the markets typically move, this is a very big sea change. Because this is telling us that capital is going to start moving out of stocks and into gold. And that's important, Trevor, because when this happens, more capital is coming into the sector. What happens? It spills over into silver, spills over into silver stocks. It spills into juniors. It spills into exploration companies. So this is what we've needed to confirm and validate this new bull market, but also set off the beginning of capital moving all throughout the precious metal sector.
If it's leaving the stock market, a lot of this is emphasizing the U.S. stock market, obviously. But what about capital, foreign capital that has been allocated to U.S. equities? Why not? And I think we're starting to see the rotation, like repatriating some of that capital out of the U.S. stock market. But we've seen other stock markets, emerging markets, like actually have pretty solid returns the last couple of months. I'm really interested in Brazil right now. I've invested in a couple other South American companies. I've even invested in Europe, and I think that's positive. But so when we say leaving the stock market, does that mean it's not all going directly to precious metals, but how does it affect other, emerging markets? I guess that's a question.
Yeah, very good point. Very good question. Because typically, well, first, we look at these charts and we see gold's breaking out against the ratios, and capital's moving out of that, it's coming into gold. But yeah, that doesn't mean all the capital. It doesn't mean enormous amounts of capital, but it's enough capital that you can see that the broader trend is moving in favor of gold in real terms. But to your question and your point, what comes along with that is typically when you have a secular bull in gold, the granddaddy of all commodities, that means you also have one in hard assets. And typically those are the periods when the rest of the world and emerging markets outperform the U.S. And so, the performance that you mentioned, that's also a signal alongside the strength that we've seen in gold and in gold breaking out in real terms. It's a signal that we could be coming into this new secular trend over the next 10 or 15 years. So and for people who are not because I've been doing some interviews with normie outlets, and what I tell them is, or when they ask me, you want to be diversified, but obviously normies and your average person, they don't want to put 50% of their money in gold or gold stocks and diversify, that much away from conventional stocks. But to your point, they can diversify out of U.S. stocks. They can go into cheap emerging market stocks or foreign stock markets that are really cheap, and now they're trending. And so there's a lot of room for those markets to move. And I think those markets are going to, really outperform the U.S. in the next 10 to 15 years as we deal with, or we have to deal with, all our debt and too many people and everybody having their money basically in the stock market. So we're going to see, a major shift, and that includes foreign markets and emerging markets outperforming the U.S. And so that's a great way for people to diversify away from U.S. stocks without having to put it all in, gold and risky resources.
Right. Let's talk about de-dollarization. Now, this is a big topic, and it will not go away. I've done presentations on this PDAC with Willem Middelkoop. I have followed this Mar-a-Lago Accord concept the last couple of weeks here, Jordan. Obviously, within those discussions, gold is a prominent figure with whatever might come. As I mentioned, I have a problem, and I disagree fundamentally with a lot of the de-dollarization talk. I do not fundamentally believe that the next monetary system is going to rely on us bartering for small silver and gold ingots. I think gold's going to have a place within the system. But what that system looks like is yet to be seen, but I think we're getting a little bit of clarification. I do believe the US dollar, the greenback of whatever form it is within that new system, is going to be continue to be prominent. Is it going to be the global reserve currency? I think it probably will for the foreseeable future. Is it going to be forever? Probably not. But how has your thoughts on this de-dollarization evolved over the last couple of years, and what role will gold have in whatever the next system is going to look like?
Okay, really good question. That's why you're sitting there and I'm here. Okay, with respect to de-dollarization, the chapter in my book was written by my buddy Vince Lancy because he knows way more about that than I do. So de-dollarization for me is a weak point in terms of all this precious metals analysis. So I'll just get that out there so people can understand it. But yeah, I probably align with your views. I don't think we're going to be bartering with ingots or silver bars and silver coins. But it just in the grand scheme of things, I think if you're thinking about my title, greatest bull market ever. The reason I say that is because you go back to the Paul Volcker, the end of the 70s, early 80s. We're not going to be able to jack interest rates up that high the way we did that because there's too much debt in the system. Like that's a big difference between my 60s and 70s analog, is that we have way too much debt now, so we can't jack interest rates up that much. So I think ultimately gold will have to come back into the monetary system in some form. With respect to de-dollarization, for me, the key thing is, I think I have this chart in the end of chapter 1 where we're looking at foreign central banks and the percent of the reserves that are in gold. And so this is a chart. I can't pronounce his last name. I think he's Jan Gold on Twitter, but a great chart. He puts it out periodically over the years. And basically, if you look at foreign central banks, they still have too much paper. They don't have enough gold. And so they are nowhere close. Like their gold holdings as a percentage of all their holdings is still way too low. So I think maybe I'm speaking more to central bank demand, but looking at that and looking what's going on, I just think they're going to continue to have to buy more gold. So I think central bank demand will stay at current levels. I think that's really going to sustain itself over the coming years. Now, with respect to de-dollarization itself, beyond that, I'm not sure. The reason this is difficult for me is because I can't put, if I can't make it quantitative, it's really hard for me to understand or describe to the audience exactly, what's going on and how it's impacting the market. But I go back to the chart in chapter 1 that I just talked about, because for me, that's how I can make it as simple as possible, is that foreign central banks, they don't own enough gold. They have too much reserves in paper. So I think they're going to keep buying. Now, so we know that, but with respect to are the BRICS countries going to develop their own currency, and the entire world's going to move to the dollar tomorrow or next month? That we hear some people have been predicting that for the last 10 years. No, I don't think that's going to happen. But it's clear that over time the dollar is going to lose strength and lose its power. And as you mentioned, I mean, our policymakers now, they want the dollar to get weaker. But I don't see some de-dollarization is a great title, and it probably conveys a lot more than what is really going on. So I hope that, again, I've mentioned this is a weak point for me, but I hope I put forth some ideas that can add some value for the listeners.
It's like a fresh martini for the gold bugs. The de-dollarization is right. It's like we've got to talk about silver here. Spend a few minutes talking about silver, because if you love 13-year basing for gold, you're gonna love the 45-year base for silver. This is pretty remarkable. You obviously have no problem at least thinking silver at $50, but maybe talk about potential where this thing may end up as soon as this thing breaks out.
Sure. First thing is, people will say silver's in a huge cup and handle pattern. Actually, the cup and handle pattern in silver failed. It's broken. It's much different than gold's pattern. But that being said, it's still in this super bullish base. So that's kind of like a nit that I like to pick, which is this is not a cup and handle pattern. It failed. If silver was still in a cup and handle pattern, I believe it would have stayed above 28 or 32. I'd have to look at it, because in a cup and handle pattern, you make this huge cup, and then when you make the handle, you can only correct 38% or 50%, but really 38%. You can only correct 38%. Silver came all the way down, and it corrected like 75% of the previous. It came all the way down to 12. Went up to 50 again, all the way. So this is a broken cup and handle pattern. But that being said, here's the nuance. It may be even more bullish than a cup and handle pattern, because it's in this 45-year gigantic base, and it's building up all this energy, and it's just going to explode when it breaks 50. So I forget what your direct question was, but when silver breaks 50, it has a measured upside target of about, we'll call it 95, just to make it close to round numbers. I referenced the breakouts in copper and oil earlier, the ones in the 04-05 period. If you look at after those breakouts, like their performance in the next year or two, they made really sharp, explosive moves in a short amount of time. So if we look at that and we project with respect to silver, silver could go to 50 to 100 in like 12 or 15 months. I really hope that it would break out and it kind of just does a more steady move. But that's my worry, is that it's going to break out and do this moonshot to 100 in a short amount of time. So that's in the setup in silver, Trevor. To me, this is in modern financial markets history, this is the greatest breakout of all time. Or if we're talking about all of financial history, this would be the second greatest breakout of all time. The greatest breakout in financial history was 1971, 1972, because commodity prices broke out from a 100-year base. Commodity prices made peaks during the Civil War. They peaked around the same level in 1920. And so 1971, 72, they finally broke above that. Gold, by the way, also, I think in the Civil War time, it peaked in the $40 area. So gold's breakout in 71, 72, when we went off the gold standard, that was also a 100-year-long breakout. So the greatest breakout of all time in the history of capital markets was commodity prices in 72. But since then, excluding that, then the greatest breakout of all time will be this silver breakout that's coming when it breaks above $50 an ounce. Now, other points about silver, I just put out, a video in my free newsletter. I talked about it last night. With respect to when does silver outperform gold, if you look at the history really carefully, what happens is typically you get a gold breakout, gold makes a big move higher, then it comes back and tests its 200-day moving average right there, or a few months after that is when silver starts to really outperform gold. So what does that mean for here and now? It could mean maybe, at some point, maybe later this year or maybe in a few months, gold will come back, test the 200-day moving average. So it could be at that point or, a few months after that. Based on history, that is when silver will start to really outperform gold. And so the problem for silver and why it hasn't outperformed gold, and again, this gets back to technical analysis, gold broke out from this 13-year cup and handle pattern. So above $2,100 an ounce, it had no resistance. It had all this blue sky where it's been moving through this blue sky. Silver has had to chew through this damn resistance from 26, 28, 33, 35. So silver's been chewing, while gold has just been sailing. So that's a big problem for silver. But eventually what happens? Gold is going to slow down when it gets above 3,000, in the 3,000s, towards 4,000. But silver breaks above 35, 37. Wow, there's less resistance on its way to 50. And then, boom, it's blue sky territory. So silver is not quite ready to outperform gold yet, in my estimation, but it's getting closer and closer. So I don't know if I covered the question directly. I know I probably veered off into a different point.
No. I think you painted a pretty good picture here. And we only have a couple of minutes here, Jordan, but I want to ask you about gold equities. But before we get to the gold equities and kind of a little bit of construction of how you might allocate capital into these equities. With the recent move in gold, and I've been waiting because I've had the gut punch multiple times of when gold makes a run, things look positive, and then there's the rug pull and you're down $100 in a day. Now, given the latest move, you mentioned that 200-day moving average in gold, that's $300 currently below where we're trading. So it could be a really tough drop, and it would take a lot of things with it. But it's really been hanging in there really, really well. Does it have a reason to be selling off? What would that reason be? What would happen if we woke up and it's like, oh, there's $150 off the gold price. There it is.
I can't think of one. Maybe, Trump says no more tariffs. There's no tariffs. I mean, that's not going to happen. I'm just guessing. But I've been following and I'm tracking how overbought gold is based on the technical momentum. We're coming up on the end of the quarter. I'm going to look at, I like looking at the quarterly RSI. So I'll do a Twitter thread about that. But the momentum in gold, it's interesting because, breadth, when you're looking at the stocks, participation is good. You want really strong breadth and really strong momentum. But then if it eventually when you have that for too long, then it starts to become bad because it's unsustainable. With respect to gold, yeah, it has surprised me, but everybody now is waiting and looking for that pullback. So that tells me maybe gold will have to go higher. Maybe it's going to go to 3,400 or 3,200 before we get a pullback. I personally really hope it pulls back so that people don't have to chase this strength. Because if you don't have exposure right now, depending on, let's just say you want to buy gold or you want to buy GDX or GDXJ. If you don't have exposure, this is really tricky because you're thinking, this is really overbought. I know the miners have just broken out, but God, they're up 100% the last few years. They're really overbought. They're expensive. I don't want to buy it. But they could have thought that a month ago, and so they missed that opportunity. So it's a really tricky situation for people who are new and looking to put money to work. And so that's why for them, I hope that it comes back a little bit. We just get a little bit of a reset. But I've been saying that since 2,700 for gold. So yeah, I think, we are getting really overbought in gold. I mean, we're overbought enough where we can have a little correction here, 5 or 7%. But I think we might have to get more overbought before we get that 10 or 12% correction in gold.
Let's talk about the equities. I was brought up in this sector here, Jordan, for the last 8 years, and I was told, don't buy the major miners. They don't make you any money. That's been a complete farce last couple of years because with exceptions of the big guys, the Newmonts and Barracks, the producers have been doing very, very well. There has been great returns, but yet it's still, people are chasing the NASDAQ, the tech stocks, the S&P stocks. It's
fart coin.
Fart coins. It's not like there's been a tremendous amount of capital moving into the gold miners, but it has been enough to see returns thus far. What does, if you look over the next 2 or 3 years, what does construction of a gold equity portfolio look like for you if you really are wanting to capitalize on this, what you see secular bull market in gold?
Now, every person is different, so it's hard to just give blanket advice. But what I would tell people is if you really want to get into the sector and do really well, there's a huge performance variance between, and you just alluded to it with the majors. Some have been garbage, some have done really, really well. So if you really want to take the most advantage, you have to get serious and really educate yourself, get some guidance from someone you trust, someone who's an expert, who's been through it. Listen to a lot of different people, and you have to really research these companies. And so try and build your own GDX or GDXJ. Pick your own companies. Do the best you can with stock selection. So I think that's what people really need to do, is focus on stock selection. The problem is most people, and I was like this up until about 18 months ago, we spend 90% of our time trying to predict macro, which nobody can do except maybe like there's 2 or 3 people in the world who can do that consistently. And then the other 10% of our time, we're going to look at these, stocks. It's a reverse. People should spend the majority of their time researching, analyzing the individual companies, and trying to find the winners. Build your own GDX, build your own GDXJ. In the book I talk about it. I focus most on, I think, production growth. Junior companies that are building mines, growing production, companies that are going to build a mine. But at the same time, I like those companies in that group that are putting a lot of money back into exploration. If you like exploration, you don't necessarily only need to buy the exploration companies. You can find the producers and developers that are sinking money back into exploration. Now, if you are looking at exploration and explorers, something you have to understand, and I've learned the hard way with that, is you have to kind of take the shotgun, more of the shotgun approach. Now, you do want to build your own basket, but make sure it's a big basket, because if you're trying to find the next Great Bear, Snowline Gold, Founders Metals, where you're going to make, 30, 40x your money, you're going to have to buy, 5, 7, or 10 of those junior exploration companies. Like if you want to be in the exploration world and partake in those stocks, you have to have your own big basket.
Mm-hmm. Mm-hmm. And not be afraid to see 50% drawdown. Don't let that shake you out.
No, yeah,
unless it's a really
true.
Bad company. Unless it's a bad company, then you should get out.
Yeah, I mean, what I just one more comment on that. Like when I'm looking at exploration companies, what I try and do is find something that at least has some value that it can fall back on. Because it's when you're like at a pre-discovery phase. I mean that's just gambling money. It's as you know, it's really volatile, it's really speculative. That's just gambling money. So when I go into exploration companies, I try and find something where, okay, at least this has some value that it can fall back on. Because I want to focus on as much proven value as it has already. Because I don't want to get into a thing, nor would I advise other people to, where you're just gambling on drill holes. Like that's, right. You don't want to be in that scenario.
Yeah. All right. Jordan, again, job well done getting this book out. I know it's a labor of love for you, and thanks so much for your insight and analysis and all the hard work that went into this book, but also that you provided us on the podcast. And I look forward to having you on more often after this unwelcome hiatus, I might say. We've missed you.
Well, I mean, I was saving up to bring you something really good, so I hope I met your expectations and met the listeners' expectations. Yeah, it's always great to be on with you, and we're coming into a real bull market. It's going to be a heck of a time here in precious metals and junior mining the next few years.
Yeah, when we've talked about multi-year base, we've talked in multi-month base of you not being on the podcast, and so the breakout of Jordan Roy-Byrne on Mining Stock Daily is going to be incredibly epic. So I look forward to it.
Oh, it was a hell of an analogy by you.
Remind us again, where can they find the book? Where can they find you? Where can they find all your work?
Go to thedailygold.com. You can opt in there at the top. You'll get on my free newsletter. I'll send you a PDF copy and an EPUB copy, which you can read on your device. You can follow all my work at thedailygold.com. Follow on X or Twitter at thedailygold. Also my YouTube channel at thedailygold.
And you can also find his stuff on clearcommodity.net. Thanks for being a contributor. Jordan, good to talk to you. Thanks for the chat, man.
Hey, thanks so much for having me.